Hi everyone, I wanted to provide an overview of Chapter 16 and looking at the first two problems. And I'm going to use problem number 1 as the kind of the example on the board, but this logic will apply to problems number 1 and 2, okay? So the first thing I want to note is that this problem deals with assets, okay? And let's read it and we'll unpack what that means in terms of assets. So Faro Corporation purchased debt investments for $50,000 on January 1. Okay, so that's the first fact. On July 1, Faro received cash interest of $2,250. Okay, so I mentioned up front that we're dealing with assets here. Okay, this is Chapter 16, has to do with investments. Investments are assets. Okay, now what can be confusing, and I've been trying to emphasize this, is that we have an asset called investments, and we have a qualifier called debt. Okay, now in problem number 2, we have stock investments. Problem number 1 is debt investments. The key here is that as the investor, okay, we are on the investor side of this transaction, we are taking cash that is in our bank account and we're putting the cash into an investment. So let's unpack what that means. Let's say that we have $100,000 in our bank account. Faro, we are Faro, by the way, Faro Corporation, and we say, you know what, we want to take $50,000 of that, and rather than having it sit in our bank account where it doesn't gain any kind of interest, which it doesn't in like a checking account, we want to take $50,000 of our cash and instead put it into an investment. So we call up our investment advisor, someone who, understands, bonds and stocks, and we say to that person, what would be good to purchase? What bonds are good to purchase as an investment? Because we want to take $50,000 cash and invest it, and then maybe earn some interest revenue going forward. And you get a recommendation. They would get a recommendation on what to invest in. Or Faro Corp has their own internal finance team doing this research. Okay, so this problem kind of points to other areas of career opportunities if you're interested in bonds and stocks and investments and that kind of thing. So they decide to, and we're not told the name of the company or that we're purchasing here. We're just told it's debt investments. But imagine they are purchasing the bonds issued by another corporation. That's effectively what's happening here. So their $50,000 of their cash goes down on January 1 because they're purchasing an investment, okay? So they're left with $50,000 over here, okay? 100 minus 50 is 50. So their cash reserve is now lower, but now they have another asset on their books that is now $50,000 higher. The debt investment went from 0 up to $50,000. I have stock investment over here just as an illustration that it would work the same if they purchased a stock investment, which is what happens in problem number 3. We would just show this asset going up in value. And of course, how do we increase an asset? We debit it. And again, remember, the asset is the investment, okay? So that's key. I want you to just note investment is asset. Okay. Now, then July 1st comes along, and this company, because they purchased a bond, a debt investment, and we can imagine a bond, they are entitled to receive interest on the bond. Now, in Chapter 15, we looked at being on the issuing side of a bond and the fact that when we issue debt, we have to pay interest expense. Here, we are purchasing the bond from the issuer and thus are receiving that interest as revenue. Okay? So this gets at this journal entry here gets at the idea that, and I'm going to actually put it down here. Let me make sure that you guys can see. Yep. Interest revenue is going to be, it's going to increase by $2,250. And not only that, we're going to receive it in the form of cash, $2,250. Okay? So this second part of the problem gets at the fact that because they took their $50,000 cash and put it into an investment, they now are going to increase their cash reserve by $2,250, more than what it would have been if they had simply, held on to this cash, in perpetuity. Now, something to point out here is that, of course, the $50,000 of this original 100 is still sitting over here in this debt investment. Now, one of the things, that they could do is they could sell this bond at a later point for either the full 50 or maybe a little bit more. Hopefully, they're going to sell it at a gain, or they can just wait until retirement, and they'll receive the $50,000 back from the company that issued the debt in the first place. So they'll eventually be made whole with the $50,000, meaning they'll eventually get the investment, the cash back. But along the way, they're going to be earning this incremental interest revenue, which is really the value of an investment like this. It is an important premise to keep note of, is that a company, and an individual for that matter, has to have excess cash reserve to invest in the first place. Okay? They could not do this type of a scenario if they were, if they were worried about paying salaries or paying any kind of expenses. Okay, the idea here is that they have surplus cash that they can invest, and better let it grow over time, meaning return money over time, like the 2,250 in interest revenue, rather than having it sit in a bank account and not earn revenue, such as the interest in this example. Now, in problem number 2 in this chapter, you're asked to contemplate an investment in a stock. It's going to be a similar example where you're going to have cash that is moved into a stock investment. And in that case, you're asked to contemplate the gain when you sell the stock later on. Okay? So I'm going to tell you right now, if you're watching this video tutorial, you're going to have a gain on the sale of a stock investment. Okay? And that's if you took your initial investment and then sold it and receive the cash in exchange. And of course, what you paid for it versus what you received when you sold it the difference of that will be your gain. So keep in touch with questions, but I hope this was helpful as a basic overview for problems number 1 and 2 from chapter 16. Thank you.